Yesterday, I might cold call for a couple hours a day and talk to half the people I call. You just never know. And sometimes it's weird timings. You just never know. You just got to keep dialing.
It's a numbers game. We looked at 2025 right after year end in January. We sent a note to all of our investors. And roughly speaking, I'll say we underwrote 200.
98% of people we talked about commercial real estate, they want multifamily, they want self-storage, but there's people who want to buy retail and industrial.
Multifamily is such a natural progression for a lot of people.
What's going on, everybody? Welcome to another episode of the Commercial Real Estate Blueprint Podcast. I'm super excited for today's guest. We have Jacob Eganhouse. He is one of the managing directors at Linville Team Partners, and we were just learning a little more about them before we started recording, but it's exciting because it's not every time we have a podcast that we get to have somebody local. So for, those of you guys who are listening and been listening for a while, our market is like the Raleigh-Durham area, but we go out to the Triad a lot, which is Winston-Salem, High Point, Greensboro, and Linville Team is they have a big presence out there. So it's exciting to have one of their managing directors on and kind of hear more about them and what they do and their perspective on that market, specifically since we're in it so much, and then just learn more about what Jacob's got going on. So thank you so much for coming on.
Thanks for having me.
Absolutely. So you gave us, kind of your background before we hopped on, but for the people who don't know you, give us a little bit of your background.
Yeah. So quick background, not born, but raised in Columbus, Ohio. So I've made the commute down to North Carolina, as it seems like a lot of other people from Ohio have. Grew up in corporate real estate. So spent a lot of time in grocery and banking before slowly transitioning into smaller organizations. So my last corporate job was at JP Morgan Chase Bank. And then from there, worked for some developers and then got into brokerage. And then eventually found myself at Linville Team Partners through a long-standing relationship with Aubrey Linville. So I've known him about 10 years, and I've been with the firm coming on 2.5 years. So recently relocated down to Winston from Columbus, but still spent a lot of time back and forth.
That's cool. What's the I'm just curious, what do you think like the primary, I don't know much about Columbus. I've really only been to Ohio once. We went to Cleveland and end of last year, which I know is probably a lot different, but what's the big differences between being in Ohio and being in North Carolina?
For me personally, I'd say honestly, there's a lot of similarities. I mean, both of them are actually growth states. You guys just have better weather, so I appreciate that. There's definitely an adjustment for me, as you guys said, on the Triad. Columbus, Ohio doesn't get on the radar for people in terms of size, but Columbus is 2.2 million and growing pretty quickly. So think of it more of like a Charlotte or a Raleigh. So coming to the Triad, it's different scale. Maybe one not quite nearly as big, but plenty to do. There is a lot of growth that's happening, and for me, kind of being quasi new, it's exciting to see a lot of the new stuff that's going on.
Yeah, Winston's unique in particular too.
I feel like Winston and is like kind of changed over. Like I have friends that live in Winston and Kernersville and stuff like that, and you'll go hang out in Clemens sometimes or golf or whatever. But it's interesting too, even for us. Like it's kind of like a new area to kind of explore because like growing up, like I would just drive back and forth to like the mountains and stuff. We never really stopped in between. Like I go up 52 sometimes in like Tobaccoville, and that area is really blown up too. I think you guys have some presence out there as well. But it is interesting. It is cool. Are you a football guy? I'm curious, like your NFL team.
Not NFL, but I'll say Columbus. The big tie in there is you got to be an Ohio State fan. So I always tell everybody socially I'm an Ohio State fan, but funny enough, more of an Iowa State fan. So I got a bunch of family from Iowa out of all places. So follow them closely. Browns are Browns, Cincinnati. We're right in the middle, so you'll get a 50-50 split.
Yeah, I grew up a Reds fan. If they're pretty terrible, but every now and then we have like a good team for no reason. But yeah, anyways.
I'm curious, being in the Triad, because we only really in the last year and a half have been trying to explore there, buy properties, stuff like that. And we've just found kind of a groove in High Point right now. But out of like Greensboro, High Point, Winston, what's your opinion on like the best place? Like if you could pick one and to buy, like where would it be?
Yeah, good question. I would say, and this is secondhand knowledge, I'll say we have some really good people on our team that are in the weeds on what they would pick and why we would go there. Probably a little bit more leaning towards Winston just because we're most familiar with it. And a big thing for us is just having that intimate knowledge of the market. And we're very familiar with all three of those, but we're in Winston's backyard. And there's a lot of good activity going on here. I know there's a fair amount of investment coming in that's going to drive some more of that growth. And depending upon your guys' investment model, which I'm curious to learn about too, of what you're looking for here in Winston or in the Triad. I feel like there's some older product here. If you want to find a B or C industrial and put in some sweat equity, there's certainly opportunity for that. And then I know over the last few years, just given where interest rates are at, there hasn't been as much new build development, but it sounds like that will start to turn back on. There's definitely demand for it.
Yeah, for sure. So we've been primarily buying single tenant industrial buildings, class C, really. And our strategy so far was kind of not intentional. Me and Jesse are definitely very much put her under contract and figure out later. We've gotten better and much better about that. We're a lot more teed up now. But the first time was like, all right, let's just do it. Let's go for it. So we went for like a very small deal. We put two under contract. Both of them were vacant. So, I don't know if it was ignorance or luck or what, but we put both of them under contract, thankfully got them both leased, and that was the value add, right? So actually we didn't do anything to those buildings because we didn't have the capital at the time. So I think if we were to restart like now that we're a little more established, we have, a couple more buildings, a lot more experience just in that span because, buying a couple, you learn so much. But we'd buy either ideally a property that's already leased with, under market rents, modified gross, that maybe needs a little light renovation where we can come in, do the office, maybe replace the HVAC, fix up some stuff, and then convert the lease to triple net. That's ideal, right? Those are hard to find. We're still open to buying vacant industrial buildings if it's a good property and a good location. That's another thing we've learned that's been a very good lesson. It's like you can buy a great deal, but if it's not in a really good location and it's empty, it's worth paying a little more money for a better location because you lease a lot faster. And the value is completely based on the lease. So that's kind of what we've done so far. And everything we've done has been seller financing except for one building. And that's basically the only way we've been able to get them to pencil.
That's impressive. So in those deals, I'm curious, are those on market opportunities you guys found, or were those off market where, you guys are bird dogging those, finding an owner and kind of getting them teed up for seller financing? Because I'd say in our experience, I wouldn't say that's kind of the standard starting point. That's, a sweet thing to get the seller to give you an opportunity to do that where a bank might not step in. So how'd you find those?
So every single one was off market. Yeah. All of them were cold calling. Some were direct to owner and some were cold call to an owner. And then we met a property manager who repped that owner. And then the property manager brought us another deal, several more deals. So all off market though, just through relationships.
That's fantastic. I always say, when I look at what we've closed to date, and just for context, 2025, we closed a little over $60 million in acquisitions, primarily in the Southeast. And most of those were not on market transactions. There's a lot, there's stuff that's on market that makes sense and can pencil, but it's ultra competitive. Yeah. So I think your guys' approach and how we kind of look at it through our brokerage lens is, find some opportunities that don't have that much visibility, and you have a little bit more opportunity to structure a deal that's compelling for us as investors. So I think that'll continue to be a sweet spot for us, is direct to owners when we can. But as you guys know, it's time consuming. You can have a lot of at-bats and a lot of phone calls before any of those come to fruition.
Yeah, 100%. That's so true. I feel like yesterday I was cold calling and I was like, man, is this thing on? Like I cannot get a hold of anybody. This is so frustrating. And it just happens that way. And then, I might cold call for a couple hours a day and talk to, half the people I call. You just never know. And sometimes it's weird timings. You just never know. You just got to keep dialing. That's why I just keep telling myself, leave voicemails. I'll even shoot texts sometimes. But so you mentioned Southeast. So you guys are buying not just in North Carolina.
Correct. Yeah. So Southeast is really our sweet spot. So we do have a fair amount in North Carolina, but we've acquired in South Carolina and Virginia. And cool. Then, just kind of keeping it within, I'll call it driving distance or a very short flight from a management and a leasing perspective is important for us. So even though I'd say our investment criteria tends to be mostly stabilized, maybe opposite sides of the spectrum from your guys' first couple deals, we're mostly stabilized. There might be a lease or two, maybe in a power center that we need to lease up, but a little bit lighter lift. And the Southeast is good for us just because we have all those local kind of relationships. We know the areas well. We know a lot of the owners well. We know the brokers, all the key players that'll help with deal flow, whether that's buying more deals or finding the right tenants for them. And then I'd say the addition there that seems out of place is we will buy in Ohio, given my background and my experience there. So we've submitted offers up there. Haven't found, or I guess got a hold of the right deal yet. But leaning into just that, really, familiar with the trade area, know all the right people, know all the tenants, so that when we need when we need to fill a vacancy, we know the right people to call.
Yeah,
that's awesome.
I'd imagine in the Rust Belt that you'd be able to find something. So just keep sending offers. It'll hit eventually.
Yeah, I mean it's a numbers game. I actually we looked at 2025 right after year end in January. We sent a note to all of our investors and kind of gave them a deal funnel of here's how many deals we underwrote, here's how many we offered on, here's how many went to contract, and here's how many we closed on. And roughly speaking, I'll say we underwrote 200, which means candidly we probably looked at thousands of deals. You get to the point where you can look at them and say that's not going to pencil before you underwrite it. So we underwrote 200, we offered on probably 50, went under contract on 10 and closed on 8. So, we
that's
know
pretty solid.
Pretty quick. Yeah, I think, when we go after a deal, we go pretty hard. And I think it helps to kind of deliver that message to brokers and sellers that we don't offer on stuff just to like kick tires or try. And we feel pretty good at the pricing that we go in at. So yeah, if we could keep that rate this year, I'd be incredibly happy. It'd be a tough thing to do. But it's a numbers game. So we'll look at a lot of deals. We'll talk to a lot of people. We'll make a lot of offers. When we put something under contract, our intent is to close. And I think our ability to close that many really probably goes back to like just creative problem solving. Like there's no simple deal out there. There's going to be something that comes up in diligence or financing. And I think we have a really creative team that will put out options to solve those issues.
Yeah, 100%. So I'm curious, and maybe this is just me being oblivious, but I didn't even know you guys bought deals. I thought I just saw Linville Team as a brokerage. Yeah. So it's good to know that because we'd love to sell you guys deals. And for people listening, what's like your buy box? What do you guys go after and why?
Yeah. So take a step back. Linville Team Partners, we have a couple different business units underneath of it. Most people, Graham, to your point, recognize us for brokerage. That's how we started, and that's what we are. Outside of that, we have a very specific and separate investment platform, which is buying those deals and putting together as investors and financing for that. And then we have another business unit, Expand, which is really business M&A. So real estate may be included, but business is always included. And it's a lot of buy-side origination there. So underneath Linville Team Partners, we've evolved a little bit, really through our clients asking us to go into some of these areas. And the natural transgression for us was, hey, we want to invest in your deals. Can we do that? And enough of our clients basically said, you guys are better at finding deals, better at, knowing the markets. I'd rather just have you guys do it than to take all the risk and all the responsibilities. So about a year and a half ago, we started this separate intentional business unit geared around acquisitions. So with that, we brought on an investment manager, Michael Holhauser, who was a friend of the firm for a long time. He came out of banking for 20 years. So that's what he grew up in. So when we talk about very rigid and thorough underwriting, he's got a banker mindset, which is very helpful. And then Nick Gonzalez, who some of you guys know, just through brokerage, always looking for deals for the firm. And then myself and Aubrey too, looking for deals, building those LP relationships and banking relationships. And it's been going well. So yeah, we closed on 8 deals last year. We have a couple that preceded that in 24. The goal is to double the footprint this year. And Graham, to talk about the kind of the buy box for us is, and it's going to sound similar to a lot of people. So we don't have anything special or super unique about the buy box. Southeast focused plus Ohio, mostly stabilized. So, we're a opportunistic buyer, but we do need it to be stabilized just given how we're structured. So I'd say, if it's industrial or retail, which is kind of our 2 areas that we excel in, north of 70% occupancy is probably the right number for us. And cap rate as a decent metric, but not a perfect metric. Typically, I'd say above a 7.5 or above. And as I know, we have some newer people to real estate here, or newer investors to real estate. Those published cap rates that we see on Crexi or LoopNet are not always real cap rates. So we spend a lot of time scrubbing underwriting to make sure that, if it's marketed at a 7.5, it's a true 7.5. And I would say more listings than not, there's some pro forma numbers in there, or maybe some fewer expenses that we know we're going to absorb as a part of the deal, and any buyer would. So we always look at those too. So Southeast Ohio, all of our acquisitions today have been industrial or retail, multi-tenant power centers. If we were to ever do office, because we do say we would buy office, it's got to be probably in Winston because we know the market really well, or the Triad because we know the market really well, and it's got to be the right basis. There's plenty of opportunity there. If somebody went and looked at the cap rates and say you can buy a ton of offices right now for 8, 9, 10 caps, there's a lot of other things to that we would look at as a part of the transaction. So hopefully that helps. I don't think I told you guys anything that's like super proprietary. I think there's a lot of people that say we want to buy the same thing, which makes it harder for us to source deals because there's tons of us looking for the same projects.
Well, it's interesting because that's definitely refreshing for me and Jesse to hear, because most of the people we work with are value add, like, us included, being guilty of it. Yeah. Like once we stabilize, we need to be at 12 cap or 13 cap, but to hear like 7.5, it's like, we cold call a lot, and we could definitely send you some stuff. And the two things we focus on, we primarily focus on industrial, but we've also done a lot of retail. And, we're calling, City Plat's similar to you guys, where City Plat's trying to acquire and buy deals, but they're definitely value add. So there's a lot of deals they pass on that would fit that buy box. And I feel like the other thing that's really interesting is 98% of people who talked about commercial real estate, they want multifamily, they want self-storage, they want mobile home parks. But in a small niche that seems like it's growing, there's people who want to buy retail and industrial. And we've kind of collected a decent list of clients who we're working with who are wanting to buy retail and industrial. And it's just interesting. And it's a lot of companies like you guys too, like other people like City Plat, and then you, and then others we know in North Carolina.
Yeah. I would say multifamily, this is just my opinion, I don't have anything to back it up. Multifamily is such a natural progression for a lot of people because they're most familiar with it. Everybody lived in a house or rented an apartment, and it's very natural for them to be familiar with that. Mm-hmm. When you start you go to an office to work, right? You're more familiar with an office. When you start getting into retail or industrial, it becomes a little bit more foreign probably for people just starting out. And we love it. Graham, you mentioned, converting your deals, whether they're gross, modified gross, to triple net leases. That's one of the reasons why we love industrial and retail is, if they're not triple net leases, we'll get them to triple net. Insurance, taxes, all of those have just gone up incredibly post COVID, and there's really no stopping those. And that eats away at margins significantly when ownership is responsible for those items. So, for me, and I'll say Linville Team Partners, short term, midterm, and probably long term, we're not multifamily buyers for many reasons, that being one of them. But two, you're really buying, I'll say you have to be an operator. Your success totally lies in property management's hands. Mm-hmm. And that's very foreign, where, our retail deals or your industrial deals, you put a creditworthy tenant in there for 10 years, triple net, you kind of, pretty low maintenance, right? If you do a thorough enough job on sourcing the tenant, it's very low maintenance, where multifamily, there's something going on 24 hours a day, 365 days, a year.
100%.
Yeah, absolutely.
100%.
Something you mentioned earlier that had me thinking, you pretty much knew almost the exact number, like the deals that you looked at, the deals that you underwrote, the deals that you offered on. Data is everything. Graham and I know that. I think a lot of people out there know that. But tracking the data that you do, like, it's even hard for me to keep up. Like, how many conversations did I have just today? Like, it's hard for me to keep all that stuff organized. What recommendations do you have for people out there, brokers, investors alike? We're all the same in the sense of we need to make sure we're keeping track of our data.
Yeah, I'm huge on it. I think at the end of the day, the inputs will lead to the right outputs. And once we start tracking the right inputs, those outputs will happen. We've made a really heavy investment in Salesforce. So I'd say that's the extreme end of being corporate, making sure that we have all the information that we need at our fingertips. So prior to that, we were in Monday. I think that's a much more available platform for a lot of people. If you build it out the right way, I think there's a lot of automations that you can do that keep you organized and keep everything moving in the right direction. But yeah, we've been building out Salesforce over 12 months. So we kicked it off January of 25. We wrapped it up at the end of last year. And that's what we use across our entire company. So all those business units that I referenced, we're all live in there. And Jesse, I'd say that certainly helps us just keep tabs on those conversations, but we also have a lot of people that work on a lot of things, and we're probably unique in that. I think in brokerage or in some of these setups, there's very much individual people working on individual tasks. We're very team oriented, so to know that I had a conversation with a broker about a deal, so everybody can see that that's a part of my team in Salesforce. To know that, oh well, he already had that conversation. Here's where they came back on price. Here's the next steps. So it cuts out maybe some miscommunications or some extra steps in between. And we set KPIs for everybody in terms of number of calls, converted leads, LOIs to offers, all that kind of stuff. So I'm a huge fan of it. It's expensive. Implementation is really hard. We hired a third-party implementer that specialized in real estate because there's obviously a ton of options out there, but we built our own model within Salesforce, and it's been great.
That's interesting. Props to you guys for investing in that for something that's specific to you. I think having like a business development person that's focused on real estate is definitely something that even Graham and I would be interested in talking to. I think a lot of investors out there would be. But yeah, CRM is just a tricky thing because it's like it's got to be like what you actually use and can use consistently. We're trying to figure that out still. Graham and I, we have Terracotta, which we love, but it's not a CRM. It's more of a dialer. And so it connects with our follow-up boss very well. So I can just call it, okay, it's a lead, and it's actually really sick. Let's say I talk to the guy and we have a conversation. I push one button, it goes to follow-up boss and has AI summary notes and everything of the call that I had with him. Now it's in my CRM. So that part is really great. We have a friend that I'm pretty sure he uses Salesforce, but he has everything dialed in the sense of like, okay, here's my leads, here's my nurtures, here's like my other calls I need to make, the cold calls will say, and he tries to get everything down to zero in a certain amount of time frame. And I think that's really cool too. So we try to do that. Follow-up bots, we're just not been very great about doing that consistently. So the discipline, the KPIs, that's huge.
Yeah.
It's go ahead, Graham.
I was just gonna say I've looked into a lot of CRMs and stuff, and I think there's a saying that's cheesy, but it's so true. It's like the best CRM is the one you use, because you can have all these different fancy things, but if you're not using it, then it doesn't matter. And Salesforce is sick, but it's I think it's definitely like suited for like somebody like you guys, where you have like multiple different business operations. You have a huge team, and the one that you're talking about, Jesse, was HubSpot.
HubSpot. Okay, that's what it was.
Salesforce is like even more complex, but it's good. It's really good. It's good for like big businesses and stuff like that, and medium-sized businesses.
I'll say if you ask 100 people that do what we do, you're going to get different answers from everybody. And I think that's probably the hardest thing. Graham, you're saying the best one is the one you use. It's so tough to kind of find all those right parameters of here's what I want to track and, garbage in, garbage out in terms of how you put your leads in and all that. But if you can believe in the system and then get buy-in as yourselves or as a part of the team, it makes it a lot easier to maintain. And I found the longer we do it, the better it gets, especially as you start taking advantage of those nurtures or those follow-ups that tend to hit. Because, if you're pretty lucky to get somebody to say yes on the first call. I think if we looked at our stats, we could probably say it's anywhere from like 7 to 15 touches is like when conversion really starts to happen.
100%. For sure. 100%. The money's in the follow-up.
Oh, from a banking perspective, I want to talk about that and your corporate real estate experience. How do you guys look at deals and see the stabilized stuff? And with that question too, kind of like a part two is, do you guys operate off of a fund or do you guys syndicate like per deal?
I'll start with that one first. So we technically have a fund model. However, it's customizable, which allows people to invest on a per deal basis. So it's incredibly flexible. There's a lot of administration that has to go behind it. But when done correctly, there's 1K1 for, everybody. So if somebody chooses to do A but not B but does C, they get 1K1 because I myself, you end up racking up a ton of K1s and tax time comes around. It's not that enjoyable. So from the back end perspective, it makes it a little bit easier on our investors. And then our thesis somewhat ties into if you find the right deals, the money will follow. So we could very easily, and I'm not saying we won't ever do it. There's probably a time in the future where we'll go out and raise a fund and then go deploy. We're really great at finding deals, and we haven't felt that pressure necessarily if we need to go find the money. And that's why we've kind of stuck with this customizable fund, or as you said, syndication. So every single time we put a deal under contract, we got a very robust list of investors. always happy to talk to new investors. So if you guys want to get on the list or want to open up your network there, happy to get you guys some visibility to the deal flow. But I guess a good example is we just put a deal under contract, sent out a note to our investors, and it was raised in about 48 hours. So
Wow.
not the biggest raise, but still, 7 figures, so a decent number. And, I guess that speaks to the syndication part of it, or our desire to go find good real estate, then go find money. But I think as we continue to mature in our platform, we'll pivot a little bit and go that true traditional fund model as we have more in-house resources on the team to go chase deals and underwrite deals. Any questions on that?
No,
Not that
thanks.
I can think of.
I mean, sounds like you guys have a really great platform to be able to okay, you got the deal in. All right, this is we got our contract. Now it's time to send it out. I'm interested to hear about that, but I'm also still curious about how you kind of look at deals as from that corporate and banking lens.
Yeah. So I would say all my corporate experience was in retail. So a couple different grocery stores, Chase Bank. And as a part of that, it was always growth models. So entering new states or expanding into new markets, densifying in existing markets. And through that, I think retail is the most scientific piece of real estate that you can pick. If you're building offices, you just build in the central business district. If you're building apartments, you can take a look at where there needs to be more rooftops. Retail is very sensitive to where you need to be. So I spent a lot of years refining that sensitivity of why people choose to go to certain places. If an easy thing for our listeners to talk about or think about is, if you want coffee in the morning, it's typically on the going to work side. You're going to see Starbucks or Dunkin' or some of the new ones, Seven Brew, Dutch Brothers. They're going to be on the going to work side. C-stores are going to be on every single corner along with banks. So, understanding where all those people went certainly help us as we buy retail centers. We know what tenants may want to be there. We know what tenants should be paying at some of these places. So, Graham, to your point on value add, we love deals where rents are under market. And we're okay if a lease dead ends because if we know there's upside there in a renewal or a new tenant, we'll certainly do it. So, for us, Jesse, I think at least on the retail side, we have a really good understanding of where tenants should be and where they're growing to. And obviously in the brokerage world, it's pretty small knit, but really well connected. I've got years of connections out there that help us in the Southeast or wherever we go. And then from just an underwriting lens, all those places are so, I'll say, rigid in why they choose to do deals themselves too. So whether they self-fund them or we'll do a lease with the landlord, there's a lot of checks and balances, whether that be financial or strategic. I'll say I have a lot of reps of putting those business cases together and pitch it to CFOs. And you learn quite a bit just why things take so long. I think retail might be one of the slower things as opposed to maybe some industrial or office deals that an approval for a national tenant just doesn't happen overnight. From start to finish, even for a simple deal is going to be 6 months, 9 months, something like that. And I think that probably has taught me a little bit of patience as we look at some of these deals with specific tenants in there. Just, it's not that they're slow. That's just part of their process at times. And it's okay to be patient for the right tenants because if they're willing to pay the same and their credit's fantastic and, even if they're paying $100,000 a year in rent and the previous tenant was an 8 cap, but they're going to be a 6 cap, it's worth it. So I'll say turning the other way, I like kind of being on the entrepreneurial side because we can go faster, move quicker, and I don't have to have those internal approvals like we have to. We have a very small group that makes fast decisions. So I've enjoyed that transition over to the entrepreneurial side.
That's cool. Something I was going to discuss is we think about, there's a broad scale of people in their commercial real estate investment journey. It's we're towards the beginning of it. City Plat's pretty well established. You guys are obviously well established. And there's all kinds of different ways you can go about it. If you go in the brokerage world or in the investing world, you see these one-off investors who are the lone wolves. They buy everything themselves. Then you see really cool companies like you guys where it's a team environment. You have a bunch of support staff. You got the people making the right decisions. Everybody's got their own lane, right? And I feel like Linville team has done a good job, even subconsciously. I didn't know too much about you guys, but I think just subconsciously you've done a good job of when I see it, I see, oh, okay, those guys are professionals. They know what they're talking about. Jesse, maybe you can speak to that too. But just driving around, the branding, you guys have done well building a good brand. So I'm curious, if somebody wants to go out there and emulate what you have built, what would be your advice?
Yeah, that's a great question. As I think about that for a second, Graham, I would say, for somebody starting cold from scratch or with limited experience, and maybe everybody shouldn't take this advice, but my advice would be like, go do a deal. Everybody wants to think about a deal. Everybody wants to talk about a deal. Everybody wants to underwrite a deal, but until you actually go through a closing and own an asset, there's so much learning that happens there. That's kind of like the biggest milestone for most people is going all the way through. And that's easy advice to give because you got to start somewhere. But I tell everybody, there's a lot of people that are in this business that are way smarter than all of us. And there's a lot of people in this business that are less smarter than all of us, that are incredibly successful. And sometimes just doing it to start is a big milestone. And I'm reminded of it all the time. I'll say in terms of LTP, as I abbreviate that, buying the right deals is important. Graham, as you talk about value add and some of the stuff that you guys have bought early on in your process, I would say don't be too proud to make a buck. Everybody wants to buy a home run deal. There's nothing wrong with singles and doubles to build the experience. And I think that's probably where we come in. Like, as I talked about our criteria, we're not looking for home runs. We're looking for singles and doubles that are incredibly reliable and predictable. Home runs, you're going to strike out if you're swinging for the fences. It's a numbers game, and that will happen. So we've really stuck to, I'll say, consistent deals for ourselves. And, relationships and reputation are everything. So as you guys, or I guess as listeners are maybe thinking about chasing deals, I'm huge on feedback. As us having a brokerage team, there's nothing worse than having somebody reach out about a deal saying they want to do something and then you never hear from them again. If you don't like it, or if you guys are going to send us deals, we'll give you guys feedback. Here's what we liked. Here's what we didn't like. That way you guys know next time when you send a deal that, oh, this is perfect for Lindenville team partners, or maybe it's not, but if it's not, here's how we mitigate their concerns. And I think that's something that goes a long way in this business, just consistent follow up with everybody. And if you're going to do something, do it. So, as I mentioned, when we put a deal under contract, we do it to close. We have a lot of money at risk. We have a lot of diligence cost. And one thing that I think everybody underappreciates is just opportunity cost. We're focused on this deal or a few deals. So, if we're doing these, we're not doing something else. And, I think, as we always just go back to the relationship side of it. So if there's something that comes up in diligence, what's the issue? Here's what our recommendations are, and kind of bring it to a seller of like, how do you want to solve this? And I think that's worked really well for us. We try to underwrite it with everything we know when we start, and when we get into it, we may learn something that changes something, and we provide a good outcome for everybody. My favorite kind of deal is one where the seller's happy, one where we're happy, and one where brokers are happy too.
Yeah, everybody wins.
Yep.
Yep.
And like you said, relationships are so important too. We talk about that all the time on the podcast. If you listen to all, but if you haven't, I'm telling you, relationships are everything. We've bought. I think we did this yesterday, but like all of our deals, but one came from the same. Sorry, two sellers had 8 of our 9 deals, which is crazy. But I mean, you build a relationship over time. They come back to you. They had a great relationship. And there's a lot of people that own one building out there, like owner user types, but a lot of these investors, I mean, it's a small world. You run into Nick Gonzalez all the time, and you want to keep those relationships, right? So that's important. Something that you brought up earlier, we kind of glossed over because it's business, but M&A, I feel like, I don't know, once or twice a quarter, we probably come across a guy that's like, hey, I want to sell my property, but I want to sell my business first. How do you guys, because it seems like you guys are almost uniquely positioned to take on that kind of a problem. Can you talk to that a little bit? I'm curious I'm sure you guys run into that, but I'm just kind of curious.
Yeah. I'll say one of our greatest strengths is being self-aware. So, when it comes to M&A, we're, say 95% on the buy side. And I'll double back to your guys' comments on relationships. We have a few buyers that we support, and I would rather do 50 deals with that buyer than 50 individual deals with different buyers. So that's how we've really structured our business for the M&A platform. So when we come across maybe an opportunity where they need to sell their business, there's very few categories that we're active in or would be experts in. So there are M&A advisors or business advisors that would be able to help somebody sell that business as a part of the transaction. My advice would be everybody's got to be in sync. If you're going to sell your business, it's not like a 2 or a 3-step process. You really need to sell your business at the same time you're doing your real estate, because a lot of buyers, I'm just going to use what we work in. A lot of buyers will look at the total number. or the seller will look at the total number and say, hey, for me to get out of this, I need $3 million. Well, a lot of times your real estate might be the bulk of that value. And if you sell your real estate underneath that and as an investment, the business buyer could have got a lot more value out of it had they got control of it as a part of their deal. So, to answer your question, we're super limited on sell side business advisory. If we're not good at something, we just don't do it. And I'm happy to refer it out. There is those business advisors that exist out there. Not all of them, just like real estate brokers, are created equal. So I think really scrubbing the relationships is super important on that front. But yeah, we come across it often on the categories that we're active in. So when that's the case, there's a ton of value that can be derived from both of them. And I think one thing that I would include is a lot of business owners are great at business. They have acquired the real estate either by accident or through their founding of it.
Yeah.
You don't have to have a full exit. And a thing that's really advantageous from like a tax perspective is like you can sell the business, get an earn out on that, but choose to lease the real estate to them, right? And then you have that ongoing stream because it's really tough to go from a very profitable business owner, get a big cash infusion, and then lose that recurring revenue. So a lot of times we see people structure some creative leases with owners that are it's a great in between versus selling everything.
We've definitely come across that where people have sold their business and they kept the real estate. I think it's interesting that you say it's the best to do both at the same time, because I feel like a lot of those guys, they want to hold on to their real estate really bad. Like that's their plan, that's their baby, it's their retirement. I know a guy specifically, he's got 10 or 11 auto shops, and that is his full plan, is just to keep the real estate.
That's somebody we should talk to. We're very active in automotive. So we'll download after the call. I'll say our key categories, automotive repair, quick lube. So a subcategory of that is quick lubes. Think Valvoline, Jiffy Lube, Strickland Brothers here in North Carolina. Collision centers. Collision centers are very active. And then a nice complement to all that childcare, med spas. So we support a lot of groups that are active in those business acquisitions.
Yeah, we'll definitely talk after this. Yeah. Definitely.
So real quickly, in terms of your guys' deals that you've acquired, as people thinking about maybe investing in deals, Graham, you mentioned maybe going solo versus finding the right people. Like, have you guys syndicated your deals? Do you own them individually? Is syndicating or putting a fund together something that's on your horizon?
Probably not. Maybe eventually. I don't, never say never. But so far, what we did is the first deal we bought was just me and Jesse and one investor. So it's just a straight LLC. The second deal was a 1031 I did from a residential rental property I had with Jesse. And then the third deal, we used hard money for the down payment, refinanced out, and we own that one. And then 4 of the buildings were a package we bought with City Plat as partners. And then one of the deals we closed most recently was a building we bought with City Plat as partners. And then the one we're hoping to close next week is another selling of a residential property. Jesse and I have a duplex that we're going to be rolling into. So far it's kind of been bootstrapped, I guess. And I think for right now, we like this, buying with kind of friends and family who we know and like, and it's pretty easy. We try to keep it simple. It's not to say, though, eventually we'll, do some kind of syndication or fund or something like that.
Yeah, especially since if there's like you're talking about how you guys run it, it's like it is a fund, but it can be per deal. I've never heard of that. That's definitely interesting.
Yeah. Yeah, it's definitely a niche model, but has worked well for us, and probably for the same reason you guys like having a partner you're familiar with. It would be easy to add in people that you're familiar with under that format. But Graham, kind of hearing your guys' progression I think it's super common. I mean, me as an individual, I own single family homes, did the duplex, did the 4 units, did the larger multifamily, and I found myself just progressively going into industrial and real estate. But I think it's those deals are, I'd say just more bite-sized maybe is the easiest way to put it, less capital intensive on the front end, where you can make money, but you can actually go do a deal, and is less intimidating than, you put a $10 million industrial asset under contract and you got to raise $3 million is very different than, a couple $100,000 single family home. So we, on the brokerage side, Jesse, I know we work with we support a lot of investors, and it's amazing. We see more and more investors who have built a portfolio in multifamily and done incredibly well. And as they either age out or maybe choose to exit multifamily, they're transitioning into those less intense assets of triple net lease industrial or retail, and it's just so much easier for them to manage over the long run. So it's kind of nice when we see some 1031s come out of multifamily.
100%. That's like
Oh, yeah.
kind of who we started the podcast. Two people in mind was like people who were just getting started in commercial real estate, and then people who were transitioning from residential into commercial.
Yes.
Yeah, multifamily is technically commercial. It is, but 5 units or more, but it's still residential commercial.
Yeah.
And it's just a different animal. It's a completely different animal. That's something I was going to say too. The nice thing that we found is, you start to think like, I want to progress into $2 million deals, $3 million deals, $4 million deals, $5 million deals. But the owner of our company reminded us of this, and he's like, the small deals are still great. Like, you can still make several $100,000 on the small deals, because what you can do is you can buy a 200,000. No, this is a prime example. Our first building was $250,000. We bought it. We leased it to the tenant. The tenant has the option to buy it for 400. That's not like, that's a good amount of money to us, right? And maybe
Absolutely.
people are in commercial real estate for a long time, that's not that much. But for somebody just getting started, if you could do a quick flip, it's going to be about a year and a half, and make $150,000. You can't buy a $250,000 house and make $150,000 unless you just buy a absolute steal of a deal. But in commercial, if you buy it, lease it, sell it, or sell it to an owner user, which is kind of the strategy I'm alluding to, if you buy these buildings that are smaller and under $1 million, there's so much demand for them from just everybody and anybody, like business owners, investors. Everybody wants to be in commercial under $1 million. You can buy something for 400,000 and turn around and sell it for 600, and it's nothing crazy. And we see it happen a lot.
Oh, yeah.
Totally agree. And for the same reason, I'll say I didn't hit on like our price points. I hit on the cap rate, but like for our model, a lot of the stuff that we're successful in is, I'll say, $5 million to $15 million, mostly because there's less competition there. So for the same reason you guys have so many buyers at this different price point, this different category, there's fewer people buying what we're chasing, which is
Yeah.
great. So it's a little bit too big for individual investors or smaller groups, and not big enough for the large REITs. So we found kind of our sweet spot there, but totally agree, especially when you take into account the time factor, Jesse, to be able to, on a percentage basis, or if you look at the IRR, it's going to be
Oh, yeah.
way better than what you can find anywhere else. And I'll say, in contrast to that, one thing that I'd say is true, and maybe you guys would validate this, is almost every deal takes the same amount of effort, at a certain point. So whether you're
Yeah.
buying a $1 million deal or a $10 million deal, you're following the same process, the same system, the same everything. And we found that, for us personally, or as our team has grown, that we chase the larger ones just because it's the same amount of work for us.
For
Yeah.
sure. And the other thing too to note is, like, for people listening, maybe not as familiar, you guys have to go after those big deals, right? You have a good team. So like, there's in the mastermind we're in, it's called Commercial Academy, and one of the guys, Jesse touched on the last episode, but I don't think we elaborated on what it meant. But one of the guys talks about how you can be a lifestyle builder or an empire builder, right? And lifestyle builder might be those one-off people. Maybe it's a couple of people. They have much smaller, not necessarily smaller deals, but they're not building a massive team and have all the structure and stuff. And there's nothing wrong with either one. Both are amazing, and it kind of just depends on what you want to do, right? So like, you guys are more of an empire builder. You have a system. You have a nicely oiled machine that's running. You have all these different staff members who are really good. I was looking at your team before this. It looks like you have a lot of people on your team, which is cool. You have multiple different business avenues. And so in order to support that system, you have to go after the bigger deals. Which is there's nothing wrong with that. It's awesome. So just for you, if you're listening to this early on, think about, do you want to be more like, have a $10 million portfolio, maybe $20 million portfolio that you build slowly over time? It's just you and a buddy, or you and a partner and a couple support staff, and mostly everything else is third party. Or do you want to build an empire? Like, for example, City Plat definitely is more of the empire side, and you guys are more of the empire side, where you're building to a bigger target. You want the team, you want the camaraderie, you want that system in place. And like I said, nothing wrong with either one. Just pick it in the beginning as you start to think about these things.
That's great advice. Totally would agree that there's no wrong answer there. I think a lot of people get started more so on that individual track, and then maybe choose to combine resources, partner up, find the right people. I know for me personally, I've done the individual route, and I really enjoy it for all the reasons that you guys probably have alignment on your partnership of, you think the same, the business model is similar, you get along, all that kind of stuff. And you can go pretty far. And I've been able to do that. And then, you find the opportunity to find people similar to you and leverage their resources. And more so for me, just kind of complement my weaknesses. So like, I feel like everybody on our team fills a void where there's, nobody in our organization is perfect in all these categories, but we have experts when we put the team together that allow us to excel at a larger scale.
Yeah. And that's super powerful. That's like the who, not how, right? You have different
Yeah.
people doing their own thing, and everybody's really good at one thing. I think eventually what I think we'll probably morph into is probably a hybrid between the two. Have like a lean team, but people who are really good at specific things. I think that's probably what we'll end up doing. But you never know. You never know. Things change all the time. So
They do. I think because our core value is simplicity is key. Whatever it's going to be simple because simplicity scales no matter how you look at it.
Yeah. That's great. To double down on that, I mean, we are fortunate to have a really robust team, but it has taken a long time to get there. We're 15 years in business. I think everybody certainly starts on the leaner, simpler side, and it's a lot easier to do. And even as we've grown, we try to keep things simple. So, Salesforce sounds complicated, and I'll say that is complicated, but we're not all in it every day. There's somebody smarter than all of us that does that, so that it makes our life simple. There's a lot of things that we do here to like reduce the friction, make the process similar, take the heavy lifting out of all of it, so we can all go do what we're best at, which is sourcing deals, underwriting deals, not dealing with the administrative type work or things like that.
100%. And to elaborate on what I meant earlier, because maybe I wasn't clear enough, like when you have a team like they do, it can be simpler than what me and Jesse are doing. Because if you have the who, not how, where each person's responsible and owns a category or a thing, everything's clearly defined and it's simple. Versus two people trying to manage all this different stuff, that can be complicated, and that's what we're working through. So it's like, we're not at all like poo-pooing big teams. We think it's great, amazing. Well, the point I want to make is like, you just have to pick in the beginning, and you're probably right. Most people will eventually get to that more team style, but you just have to think about it in the beginning. And it's better to start if anybody knows. I know Jesse does. Rob Deerdeck, he's awesome. He's like a huge entrepreneur. He's started all kinds of businesses. He has a whole business about starting businesses, and he's got a whole podcast. But he talks about start with the end in mind. And so basically, like if you just know from the beginning, all right, I want to get to this many assets, or this is the cash flow goal I want, or this is the lifestyle I want, and you think about that and plan it out, then you have to decide which way you're going to go and how do you want to do it, because it'll help you so much in building your business if you know that in the beginning versus just trying to wing it.
It's great advice. Yeah, often overlooked. As people put deals together, they don't have a number or a unit count or a dollar amount in mind. It certainly helps track progress too.
For sure.
Yeah.
Well, this has been incredible. I think it's all great information. If people want to, send you guys deals or connect with you on the brokerage side or the M&A side or anything we discussed, what's the best place for them to reach out to you?
You can go to our company website, and all of our business units will be on there. It's linvilleteampartners.com. Look us up on there. You can find all of our email addresses, LinkedIn, shoot us some notes. We're always happy to talk deals. I'm a firm believer in a strong network. So, other operators out there similar to us, we're constantly sharing best practices and good notes.
Awesome.
Well,
you guys heard it here. Go check them out. Check out their website. Like we've discussed before, we have a lot of respect for them. We see them all over the place in the triad. You guys are crushing it. I look forward to, furthering our business relationship. And if you guys enjoyed this episode, go give us a 5-star review. We only have a couple. We have a lot of listeners, which is awesome. We appreciate you guys. If you have any questions, feel free to reach out to us, email, Instagram, whatever it is. And we'll see you in the next one.
Thanks, Graham.
Thanks, guys.
Thanks, Jesse.